we're going to talk about last part of the audit cycle. So we've been auditing operations type stuff, right? Now we're going to do financing and investing, right? Those are the kind of the three major categories of activities at an organization: operations, financing, and investing. So we've done operations, right? The purchases, the sales. And now we're going to move on to how they finance and invest stuff. I'll let you kind of look over this on your own, but rest assured, financial shenanigans happen in this part of the cycle too. This part of the cycle has more complex transactions. It has off-balance sheet items. There are a lot of high dollar transactions. So if you're doing earnings management and you can transfer just one of these transactions in or out of the period as you need to, it can make a big difference, right? If you can move a liability off that balance sheet and it's a mega multi-million-dollar liability, that's going to make you look good, right? So this cycle has a lot of estimates, a lot of different ways to account for things, and a lot of gray areas, like what point does that lease become a capital lease and therefore a long-time liability? When is it an operating lease, right? So there's like some lines there that you have to cross to make it into a capital lease, and maybe you could fudge those a bit. So a lot of opportunities in this cycle. You wouldn't think so. You think, oh, these are all big high-dollar transactions, and it'd be easy to catch them. And usually, if you look at them, it's not too hard to catch them, but the idea is they're complex, they're estimates. Who's to say my estimate's better than your estimate? So it does happen. All right. So this cycle, typical activities are concerned with using the funds and the sources of the funds, right? So I'm going to invest in PP&E. I'm going to invest in some kind of an asset that's another stock or a debt of some other corporation, right? So there's a lot of different things. I'm going to invest in some kind of intangible, right? I invest in another company and now I've got some goodwill, right? So there's a lot of weird accounts in this cycle. Accounts that are tangible and intangible, right? So if you've been investing in a patent, things like that. This has the stockholders' equity section. Stock repurchases like treasury stock, stuff that you're going to use to pay bonuses to people, things like that fall in here. Right, and some of these investments in other organizations are going to involve things like equity method accounting. So how about that other if you have equity in that other company, now we have to worry about their financial statements, right? Consolidation, goodwill, taxes fall in here, derivatives. So this is where if your organization hedges, right? If it's a multinational, maybe they hedge currency in some form. Maybe if they're, I don't know, like Southwest Airlines might hedge for jet fuel prices, right? So this is where a lot of unusual transactions occur, and so you want to be on your toes. All right. So on the next page, next slide, we're gonna have one of those flow charts that shows you all the parts of the cycle. Basically, your financing. Right, as we learn in finance classes, we're either going to get some debt or we're going to issue some equity, right? And so there should be some financial planning that involves what kind of capital we're going to raise, how much do we need. So there should be some planning, right? So this can also help you if you understand, here's their cash budget. They say they need this much cash, but their cash is tied up in this or that. Or they've cashed this out but not used it for what they said they were, right? So this can tell you some things are going on. What they invest in. Now remember, these investing transactions are going to result in your client owning some property, plant, and equipment or some other company, right? They might invest in stock of another company. They might invest in debt. They might invest in intangibles, right? and they'll end up, or they invest in another company and consolidate it and end up with goodwill, things like that. So because these are a lot of assets in the investing part of the cycle, you have to worry about that segregation of duty, right? Because if you invested in bearer bonds, somebody walked off with them, right? So you have to worry about authorizing, custody, recording, right? So keep that segregation of duty going, and of course reconciliation. All right, so here's the idea behind this cycle. There's a capital budget, right? So you've learned how to do that. So cash flow gets forecast. We're going to need this much cash, right? We're going to need to invest in this, right? We are going to be operating, and we need this. So there's this cash flow forecast. So then, based on that forecast, we are acquiring either raw materials and stuff that we've already talked about, right? So in the acquisition cycle, right? So that's audited there. But if we're acquiring PP&E, right? In other words, in this cycle, we're going to need some new factory or something, right? So we're acquiring PP&E. That's in this cycle. We're going to need cash in the fourth quarter, but a lot of our cash is coming in the second quarter, so we'll have to invest it in some securities or something, right? We just want cash sitting around, right? So they should be planning, and in this quarter we'll sell these securities, things like that, right? So we convert these resources, and of course invest excess funds, right? So this cycle is where we're planning for what we need money for, and there are some purchases going on, but they're of PP&E and they're of investments, right? It's not like purchases in the acquisition cycle we already talked about. That acquisition we were talking about. Okay, we're purchasing raw materials, we're purchasing inventory to resell, right? So we're paying expenses, right? That's operation stuff. Financing investment stuff is the PP&E, the intangibles, the goodwill, stuff like that. All right, so what are the important accounts we need to think about in this cycle? Well, the important accounts are investments, right? These can be super high dollar accounts, right? That's the PP&E portion of your balance sheet, and also your other investments, like if you have an equity investment in some other organization, if you have a debt investment, you've purchased the bonds of some other organization, you've made you have some kind of note receivable, investments, goodwill, patents, copyrights, investment type things, stocks, bonds, anything you can invest in, which can include property, plant, and equipment, right? The factory building itself, that kind of thing. All right, long-term debt. So these organizations in the investing cycle, they're either issuing equity or they're issuing debt, right? So they may have, long-term loans, mortgages, bonds they've issued to borrow money. So then that's going to bring up this whole issue of paying interest, capital stock. Obviously, we're talking about public corporations in this chapter, so obviously they've issued stock, various kinds, and they've probably purchased it back, so they have some treasury stock. So those accounts all have to be looked at. Retained earnings. Obviously, retained earnings contains the elements from operations in terms of past net income, past dividends, right? So retained earnings we need to make sure that if something was restated in the past, retained earnings got changed, things like that, right? So if you've audited the revenues and expenses that went in to create net income, and dividends aren't too hard to keep track of, then retained earnings should be okay. It's not like it's terribly difficult to audit, but you do have to look at that. It's an account. So where does our risk of material misstatement come in, right? Well, obviously there's inherent risk and control risk, right? So the big risks, the inherent risks in this cycle, right, that we're going to have to make sure there's controls in place for. So the inherent risks are that these are very complex transactions. They're typically high dollar transactions. A lot of lot of what goes on here will involve fair market value. A lot of the investments have to be marked to market, depending on how they're classified, right? And how they're classified is totally management's tells you, these securities are held for sale. These securities are held to maturity bonds. We're not going to sell them, right? So management tells you how they're classifying those assets, right? So you have to think about, well, is that true? Like, did they later sell them? Did they say in this period they were held to maturity, but look, they sold them in the next period, right? So you have to think about these things. There's related party transactions. This is where lease accounting comes into play. And again, an operating lease versus a capital lease has those, they have these lines, right? So it's like a certain percentage of using up of the asset. Then you have to put it as a capital lease. All that stuff you learn in intermediate. Loan covenants come into play because, what is a loan covenant? Well, we should talk about that real quick. This is the part of the cycle where they might issue bonds or borrow large dollar amounts from banks. So when an organization borrows large amounts, the people who lend the large amounts want to have some say to make sure they get back that money. So they'll have these loan covenants, right? And part of the contract for the bond or the loan, they can be like a book. I used to work in commercial lending, and they can be like an actual book. So it's a contract that they have with their banker or the people who've bought the bonds. And the loan covenant will say things like, can't pay dividends before you pay interest on the bonds. Can't fall below a certain amount of working capital. You can't, it can be anything, really. Can't invest in something else until you pay off this bond. Can't sell this asset without paying off this bond. Things like that. So it's possible for organizations to violate these loan covenants. Even though they're still paying back the bond, they pay the interest on time every single quarter. It's certainly possible that they are violating a loan covenant, in which case maybe the loan becomes due, and they certainly don't want that. They don't want to have to, that whole loan would then become a current liability they have to then pay off, right? So you don't want that. So that causes them to do things like earnings management, right? So loan covenants can be an issue you need to understand and look for. Impairments. So you have something on the book. I always think of goodwill. But a patent and any kind of intangible could become impaired and not worth what you have it on the books for. Right? So you are, you make floppy disks, and you have the patent for making floppy disks, and all of a sudden someone comes up with a flash drive. Well, you still have the patent, but is it impaired? Oh yeah, nobody's going to buy your floppy disks anymore. Stuff like that. Presentation disclosure. This is where there's a big risk of this assertion going wrong, just because they want to call a capital lease an operating lease. They don't want to disclose contingent liabilities, things like that. So there's a lot of stuff that comes into play here that's judgment, that's estimates. That's the reason it's classified this way is because management said it's that way. So you've got a lot of room for management to play around and do some earnings management and make the financial statements look better. So this is an important place to look. All right, so those accounts are what's going on. So in these accounts, of course, we have to test for all the assertions, but some are more likely than others, right, to be a problem, right? With investments, obviously they'll say something's worth more than what it really is, right? So that's certainly existence, occurrence, and valuation are the more problematic assertions, right? With completeness, you typically don't want to understate investments. Could it happen? Oh, sure. But valuation and, right, so if you're you're not, if something has to be valued at fair value, what's that, right? Existence, do they exist? Somebody, hey, they still can make up stuff. Long-term debt. So existence and occurrence is not as big a problem as completeness is, right? They don't want to, right? You want to make your debts look low, right? So they move them off the balance sheet into these special purpose entities. They just don't record them somehow. So completeness is more of a problem. With capital stock, it is certainly possible that something could not be complete. I would say presentation and disclosure is a big problem, because this is where management might exercise stock options. So you'd want those options to be allocated correctly. Retained earnings, again, completeness is the main issue. Just making sure that everything from prior periods gets into retained earnings. And sometimes prior periods have restatements. So that's what's going on there. Alright, in the next video, we're going to start talking about internal controls.